Welcome. Today we're unpacking a high-stakes question that every serious restaurant operator eventually faces. How do you choose the right Restaurant 365 partner? Restaurant 365 is a powerful cloud ERP that can connect accounting, inventory, purchasing, payroll, POS sales, and reporting in one restaurant-specific system. But here's the key insight that changes everything. Software alone does not create clean books, reliable inventory, or confident growth decisions. The partner you choose can determine whether R365 becomes a scalable management system for your entire operation or just another complicated and expensive tool collecting digital dust. In this video, we'll move from the problem to the 6 partner types to timelines, pricing, governance, and finally a clear, repeatable selection process. Let's start with why this choice matters so much. So why do these partners matter so much? Here's the surprising truth. Restaurant 365 is a genuinely powerful platform. It unifies accounting, inventory, purchasing, payroll, and POS data into one restaurant-specific system. But here's the critical insight that research consistently confirms. Software alone does not fix broken processes. Bringing an ERP into a disorganized business simply gives you disorganized data, but faster. The real question is not, can Restaurant 365 do the job? The better question is, can our restaurant actually implement, integrate, govern, and use it well? That matters because restaurants run on thin margins, fast decisions, and messy operational data. A bad POS mapping, a chaotic vendor master, or inconsistent inventory items can turn every report into noise. But a strong partner can shorten time to value, improve financial accuracy, stabilize inventory controls, and help leadership trust the numbers across one location or 20. Without the right partner, even the best software becomes an expensive digital paperweight. Here's where most restaurants go catastrophically wrong. The gap between software promise and restaurant reality is wider than most operators realize. ERP projects almost never fail because the software lacks features. They fail because planning is weak, data is dirty, adoption is low, and nobody owns the messy details after go-live. When you choose the wrong partner, or worse, no structured partner at all, you'll see the same failure modes emerge like clockwork. Inaccurate financials that make lenders nervous, broken POS mappings that corrupt your sales data, inventory item chaos that destroys COGS accuracy, delayed month-end closes that blind your decision-making, and worst of all, unclear post-go-live ownership that leaves your entire team drowning in exceptions with no one accountable. If vendor names are inconsistent, menu items are mapped incorrectly, or managers don't follow new workflows, the system will simply organize the confusion at higher speed. The next step is understanding the 6 distinct partner types that can save you from this fate. The breakthrough comes from recognizing that not all partners do the same thing, and stop asking who is the best partner, and start asking which partner owns which part of our operating model. 6 distinct partner types each serve a unique purpose. First, implementation partners run your entire project plan, managing data migration, chart of accounts configuration, vendor and recipe builds, POS mapping, roles and permissions, testing, and go-live execution. Second, outsourced accounting teams own your daily financial discipline, AP and AR workflows, bank reconciliations, sales audits, month-end close, and variance commentary. Third, fractional CFO partners translate your R365 data into strategic intelligence, forecasts, cash plans, KPI dashboards, lender reporting, and unit economics. Fourth, systems integrators connect your full technology stack, POS systems, payroll and HR platforms, vendor EDI feeds, delivery reconciliation, and business intelligence tools. Fifth, training and change management specialists build role-based SOPs, job aids, and adoption rhythms that turn new workflows into repeatable habits. And sixth, often overlooked, your internal owners, the executive sponsor, controller, operations lead, and general managers who must co-own accountability, not outsource it entirely. Once those roles are clear, we can connect them to timelines and measurable results. Now let's examine what actually happens during a well-run implementation and why timelines matter so much. The research reveals a precise and repeatable rhythm. It starts with discovery and current state assessment, moves into data cleanup and chart of accounts mapping, then vendor and item builds, role-based setup, rigorous testing, and finally cutover. But here's what truly separates successful implementations from disasters: the 30, 60, 90-day stabilization window, what the best partners call hypercare, after go live. This critical period reconciles your first full operational cycles. AP entries, payroll, bank reconciliations, sales audits, and reporting exceptions all need immediate attention and tuning. Integrations are often where projects win or quietly slip. POS data, menu items, tax rules, vendor records, delivery channels, and payroll feeds must all be governed early and precisely, and success must be measured, not assumed. Define your metrics upfront: close cycle time tracked against benchmarks, invoice processing speed, exception rates, COGS variance, margin by unit, reconciliation timeliness, and active user adoption. Without these baselines, you're flying completely blind. Here's the implication that many operators miss. Choosing an R365 partner is also a commercial and governance decision, not just a technical one. Pricing is never one simple number. It depends on your number of locations, modules activated, integration complexity, migration depth, data cleanup requirements, and ongoing support needs. Some work fits a fixed-fee project structure, some needs time and materials, and ongoing accounting or fractional CFO support will typically become a monthly retainer. That is precisely why the statement of work is so critical. It must define scope, exclusions, deliverables, milestones, acceptance criteria, responsibilities, service levels, and change order rules. Ambiguity here is where projects go wrong and budgets spiral. Risk controls matter equally. Require a serious discussion around least privilege access to payment data, PCI DSS awareness around POS touchpoints, and payroll tax classification controls before anyone receives system access. Establishing milestone gates, readiness, testing, pilot, go live, and 30, 60, 90 review creates accountability checkpoints that protect your investment every step of the way. The solution is to make partner selection a disciplined and repeatable process. Before you even issue an RFP, get pre-RFP ready. Inventory every single dependency: your POS systems, current GL structure, payroll and HR platforms, banks and cards, vendor master, reporting packs, legal entities, brands, and unit count. Clean up items, recipes, locations, classes, and vendor IDs so you're not handing a partner a mess. Appoint an executive sponsor with real authority to remove blockers, because sponsorship gaps are one of the top derailers of ERP adoption. Then shortlist 5 to 7 partners, run structured interviews using identical question sets, and force proposals into comparable formats. Score them with weighted categories: restaurant industry depth, R365 platform expertise, integration experience, accounting quality, communication, documentation, change management capability, service model, price transparency, security posture, and cultural fit. Watch carefully for red flags: vague deliverables, weak migration plans, no verifiable references, unclear staffing, and single consultant dependency are all serious warning signs. Pilot the hardest integration before final commitment, if at all possible. The best partner is not the cheapest or fastest. It is the one that aligns precisely with your implementation needs, your ongoing operating cadence, and your growth plan. So let's bring the full story together. Restaurant365 can be a genuinely transformative platform for restaurant accounting, inventory, purchasing, labor visibility, POS data integration, and enterprise reporting. But the return on that investment depends entirely on implementation quality, data discipline, integration depth, governance, and adoption. The right partner turns your daily operational workflows into reliable financial and operating intelligence. The wrong partner leaves you with inaccurate financials, perpetually delayed closes, broken data mappings, and unclear ownership that paralyzes your team. So enter the selection process prepared and disciplined. Clean your data before the RFP, define your full scope, run a structured RFP, use a weighted scorecard, check references rigorously, test the hardest integration before signing, and contract for real accountability with a 30, 60, 90 stabilization plan. If you do that, Restaurant365 becomes far more than a system of record. It becomes a scalable management engine that powers confident restaurant growth, whether you operate 5 units or 50. The paradigm shift is this: choosing a Restaurant365 partner is not a software decision. It is an operating model decision that affects accounting accuracy, inventory discipline, labor visibility, compliance controls, and your readiness to grow. Choose wisely, and your data becomes your competitive advantage. Like and subscribe for more helpful videos like this. Connect with Forks for the experienced accounting professionals your restaurant needs. Details in description below.